Some companies are facing existential crisis. You see, value investing really works. If you have companies that are unprofitable and they have no way of getting to profitability, eventually the market will take care of that. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a more intelligent investor. Some of you have been sending me this article that was published on June 14. Real estate tech in existential crisis as housing sours, stocks plunge, new money out of reach. Redfin and Compass tries to survive by cutting staff. Opendoor, Zillow, and Zeg. Here's the problem with companies whose hype and hoopla stocks have collapsed by 80 to 90%. They are facing an existential crisis. They cannot raise more money, but their operations were never designed to make money in the first place. Their business model relied on burning cash, and then the whole thing was designed from the get-go to use homemade growth metrics to bamboozle investors into buying the stocks and pump up the shares. Then the companies, based on their high share price, could issue more shares and raise more money and feed their cash burn machines. The plan was to fake it until they could make it. And this article talks about Redfin, which was called the Amazon of real estate. Compass, Zillow, beloved Zillow, and Opendoor. So if you look at, the stock prices of all of them, look at this. Redfin was so hot, from the pandemic. Look at that performance. And now it's crashing. And a lot of things are crashing. But you see, let's look at the other ones. Compass, it was just pretty much on a continuous downward trajectory because they started trading in 2021, so it's just down, down, down. Zillow, same thing as Redfin. During pandemic, huge run-up, and now huge sell-off. Opendoor Technologies. You see, this is showing again from December 2020, pretty much continuous downward. And so let's look at some things like, let's type in Redfin stock to YouTube, see which people covered it, okay? Brian, Feroldi thought it was a good idea. Ooh, of course, Kevin had to talk about Redfin stock. He's a real estate expert. So Tom Nash, let's take a look at the other one. Compass. I don't really see any familiar faces on Compass. Zillow. I can't stop buying Zillow stock. Here's what changed. The popular investor. Zillow stock is way better than you think. Everything money. I doubt that they like this because they're value investors. Opendoor was a little bit more popular. Is Opendoor a buy here? It's time to triple down. Of course, the technicals, right? Time to triple down. Wall Street is paying cash for Opendoor's homes. I don't see Meet Kevin here. Wasn't he not talking about? So anyway, you see, this is very problematic because when you are investing in unprofitable growth stocks, you need to ask yourself a question. Number one is, can they become profitable? Because that's the eventual goal. And you see many of these names here, as this article states, they weren't set up to be profitable. They had no intention of being profitable. And now, because they can't raise any money, they have no choice but to become profitable or they will die, right? So what's going to happen when they start cutting costs? Advertising, right? Advertising is like the first thing that goes. They start cutting. And what do you think happens to revenues? Revenue growth collapses or turns negative because revenue growth, it doesn't just grow just because you put 10, 20% in your Excel. Revenues grow because resources are being invested for that growth. And as long as the stock price keeps going up and we are in a bubble, then investors are willing to overlook whether the company has a business model that even works, whether the company will ever be profitable. Growth, as long as it grows, they want to pay unlimited price. And then they like to compare it to other companies who are also in the same boat. And it's like, oh, look, this one is not expensive because it's trading at so and so. Look, at the end of the day, your company has to eventually become profitable. It has to have a way of becoming profitable. If it doesn't, it's going to die, no matter what the stock market does. But a stock market downturn like we're experiencing right now, it makes it worse, because when the stock prices start going down, then investors don't have appetite for unprofitable growth, and they don't want to finance those companies. And when there's no one to write the check, those companies either go out of business and go to zero, or they become profitable. But the path to profitability, when they are not even designed to be profitable, is excruciating pain, because investors don't want to invest in companies that don't have growing revenues. They want to see growing revenues. But there's a price. For companies like this, there's a price that they have to pay for growing those revenues, and that is negative profitability. And when you start turning the company around to become profitable, revenues are not going to grow as fast. They can grow negative, and nobody wants to own a stock that has negative revenue growth, because they can buy simply profitable companies, right? So it's a catch-22. And now, unfortunately, a lot of people are waking up to this reality.